Now we're going to turn to jobs. And before we get into jobs, we just wanted to touch on an update from the Colonial Pipeline. So as we said in the EIA show segment one, in the Colonial Pipeline special or segment one, we talked about what ransomware does, where ransomware takes data, encrypts it, and then you have to pay a ransom in order to get the encryption code. Now, what Colonial has said that they will not pay the ransom and that the company is instead working with cybersecurity firm Mandiant to restore the data from backups and rebuild the system. So they have backups, so they have to bring the backups forward and then rebuild the system to make sure. So you essentially delete all of the ransomware, make sure that the ransomware is gone in the system, and then you bring you essentially reload the data and then rebuild the system, which takes time, which is why they're testing it at the smaller locations to make sure that they're doing things right so that you don't have a bigger issue on the main lines. Now we want to come back to the U.S. jobs. So this is looking at U.S. jobs by industry, the total, you can see the highs in terms of job openings, U.S. job openings by industry total continuing to move up. But where are the jobs? Why is nobody taking these jobs? And that's what we talked about in the previous segment. And now we're going to take that to the next level and look at, well, we have seen people go back to work at the lowest level in terms of just payments. Because, and as we said in the previous segment, when we look at the decline in hourly wages, right? Hourly wages went down in a big way. But how would you get to hourly wages? Well, you have the wages divided by the amount of people because you're looking at it against all individuals. So if you have the denominator getting bigger of more people going back to work, but at a lower rate, that means the numerator gets smaller as the denominator gets bigger, so the percentages look worse, but it's actually telling you that people are going back to work at lower wages. So you are getting people filling these jobs. They're just not at this wage that what I think many would hope for in terms of wage inflation, because we continue to see this compression on what people are getting or being paid for. So then when we turn to the small business job openings, you can see that it's at a record high. I mean, the NFIB is at a record high because job openings are hard to fill, but they're not willing to pay more because prices are already through the roof. And if you think about a small business, there's only so much wiggle room within the margin that you're going to have to pass through some of these additional costs. So what does that mean? That means that if you can't pass through the cost, you can't hire someone for a higher rate until you think the market can tolerate that. And many individuals at the NFIB in their surveys don't think the economy is going to get much better or have gotten a bit less optimistic. So they're going to be less likely to hire some of these individuals. So then when we look at the monthly change in courier and messenger jobs, you can see that the seasonally adjusted, so you're adjusting, you actually had a big drop in courier and messenger jobs. And why is that? It's just in general, a lot of these jobs have been taken. You've had some people that have left these jobs because they've gotten full-time instead of part-time. And you're going to continue to see these pressure points as to what is going to happen with employment, because we continue to see a disconnect between skilled labor, the skills for the job, and the skills that are available from the pool of assets or employees. And this disconnect is creating some of this delay in hiring individuals back. So the employment population ratio. So when we look at employment population ratio on the left, you can see that in general, employment it is staying at about 57.5% or in the 1970s level. And the employment population ratio for 25 to 54-year-olds, we're still nowhere near where we were prior to COVID. Now, this is a mixture of early retirements, people adjusting, but we're just not getting back to the normalcy that I think people were hoping for or expecting, because there is still the residual issues of I've already passed through so many price increases because of my raw materials, because of my supply chain. I don't have the ability to see a huge step up in my labor cost in order to push this through. And again, these are some of the slowdowns that are remaining. So let's take it from this perspective. Well, let's look at what has happened so far in terms of just at the home level. Well, mortgage delinquencies as a percentage of total loans has come down. Foreclosures as a percentage of total loans has come down. So we're seeing a little bit more normalcy in the system where, and it also comes with the CDC being knocked down for delaying foreclosures and forbearance in general. So you're seeing people make up their monthly totals. But as this accelerates, you're going to have people pushed back into the jobs market because they're going to have to start making payments that they may have delayed or deferred for an extended period of time. So you're going to start to see some of that normalcy, but that should drive more people back into the jobs market. But at what percentage? Because as we said in the previous segment, that inflation continues to eat through. So you're going to have to get back to work to cover your higher prices of just living while trying to work off some of the debt that has been incurred over that time period. So then the loans and leases and bank credits. So when you look at bank credits, so all commercial banks divided by deposits. So deposits have increased exponentially, but yet the loans and leases continue to go down. And it's a mixture of two, where banks aren't willing to loan at the rates that are available, but they're also getting this huge increase in deposits, which is why we continue to see the overnight rate get stuck at 0%. So one of the things that we've been talking about and we continue to see in the system is that participation in the overnight RRP facility is going to continue to climb. So the overnight reverse repurchase agreements is going to continue to go up. We're already approaching 200 billion. We're going to go well through that because we're seeing additional push into the deposit side, which is just limiting the amount or increasing the amount that they have to invest overnight. Markets at zero, they're trying to protect themselves, so they're going into the overnight markets. So then when we turn around and look at supply and demand for commercial and industrial loans, the loans to large and middle market firms and then loans to small firms have gone negative. So then when we look at net percent of domestic respondents increasing spreads of loans, they also see it as a negative. So you're not getting incentivized to lend. And that's where this inflation comes in, where as inflation goes up and as the expectations of it go up, you want to make sure you're going to get a rate of return greater than inflation. So you want to get something for your money. And right now that is creating some of those issues within the system. But when we look at just taking for an example, so we're talking about the US, but let's look at India for a second. So more state level lockdowns pulling down India's activity index. So when we look at India, because we're going to talk about inflation in India, we're going to talk about jobs in India, you're seeing that daily activity indicator come down even as the stringency index isn't reaching what it was through June and August, because people are reacting to what they're seeing in the system, which is less jobs, more inflation. And even though inflation has pared back because obviously mobility, it's still above 4% because prices aren't coming down that much. And that's why when we look at India as a place of just looking at some of that inflation capacity, it's something very similar as jobs come under pressure again in India. And this is just an example of another location that is seeing that pressure. So when we look at oil demand and normalization, it's going to be very difficult to see some of this come back to the level it should, just because the underlying consumer is just not in a good spot on an economic level. So then let's come back into the U.S. and look at leaders and laggards. So when we look at industries with the highest and lowest rates of employment growth for the most recent months, so we have scenic and sightseeing, obviously coming back for the different levels of seasonality, amusement and gambling, arts and entertainment, sports, performing arts. So things that were shuttered for so long, this is where we're getting the bump. We're getting the bump from the reopening. So, but again, this was expected. We got the bump from the reopening, but what are we seeing slowdowns in? Business support services, motor vehicles, employment services, temporary help services. So as people go full-time, you're getting less temporary work, less of that capacity coming through, which is a net positive, or it should be, because when let's look at this on a mathematical level now. So when you look at temporary help services, current wage is $20.53. Sporting goods, hobby, book, and music stores is $16.49. Arts and entertainment is $19.62. Amusement, gambling, and recreation is at $16.49. So you're giving up higher wages for more permanent work. And again, this is some of that friction where couriers and messengers, 18.71%. So you're getting some of the movements back into full-time work, but some of it is at a lower price point, which again is going to lead to some of the slowdown in spending, even though you could get some better job numbers, but it's a conversion ratio. You're going to have to see this conversion, and it's converting at a lower wage, keeping that wage, the wage inflation or essentially wage compression intact. So now when we look at this on the labor market conditions across industries, when we look at April, leisure and hospitality, not surprising, but when we look at other total non-farm, the expectations missed wildly because we had a huge surge in March, which was that reopening trade. We had a big bump in March because that was when we had, February into March, everybody wanted to reopen, get back to it. And now we're starting to see some of the repercussions of this delay, and it's all a lot of it is being driven by price. And you can see just how short we are on the leisure and hospitality side, and the non-farm payrolls by sector changed since 2020. We're still not getting back there. And while we're making some headwinds, you also had a lot of restaurants close. You had a lot of companies that went bankrupt or shuttered doors, and now you're going to have to wait for new ones to reopen, and you're going to have to wait for new ones. So this is that lag that we're seeing in that employment side. So when we look at the economic data, because we keep talking about it, the average hourly earnings were up that 0.7% month over month, but the non-farm payrolls missed, again, 266,000 versus the expectation of 1 million. But then the prior month, which was at 916,000, got knocked down to 770,000. So you're seeing some of these changes that are continuing throughout the system. So then when we look at average hourly earnings year over year, you can see that it was expected at negative 0.4, came in at 0.3, but the prior was 4.2%. And that's where we keep talking about some of these adjustments. While the unemployment rate remain, even though the numbers weren't as good, the unemployment rate came down, but not as much as expected, because we did see people coming back into the workforce, which is going to weigh against that. And then when we look at just in general, some of the wholesale inventories, they're pretty much coming back to where they were on the month over month, but the wholesale trade sales are at 4.6%. So you're still seeing sales move through, but the inventories is kind of where some of those shortfalls are. So when we look at this chart again, looking at the U.S. broad labor market, and we look at April 21, this is where we continue to come to the wage growth. So you can see February 20 was that red line. Then you look at November 20th, which is the dotted line. Now we're looking at April 21st, which the wage growth is getting worse and worse. And that's why when we keep talking about all of these different capacities, job openings are great. You'll have job openings or at full employment levels as of April 21. But yet you're not getting low-skill wage growth. You're not getting wage growth. You're not getting long-term unemployment coming back. Long-term unemployment getting better. Your initial claims are still elevated. There is a lot of negativity because, and again, a lot of these pieces lead to consumer purchasing. And that's why we continue to see some of these shortfalls that are just remaining in the system. Now, total revolving credit owned and securitized, the total revolving credit owned and securitized is coming back up, but we're not at the level that we were prior to the pandemic, where total non-revolving credit owned and securitized continues to go higher. So you're also getting a pivot with how people are managing their day-to-day life in terms of the credit side of the equation. And the percentage of banks tightening standards, when we look at tightening standards, they're starting to loosen up again. And this is for credit card loans. So we're starting to see some credit get pushed through. And this is where we're starting to see a little bit of that adjustment. So tightening standards, they're actually opening up standards after loosening them. And you're seeing that maintained through the system. But the problem is, what happens next? How are they going to pay that back at rising costs and lower job levels? So then when we look at the average weekly hours for all private sector employees, average weekly hours went back up. Even though the hours went back up, they weren't at a higher rate because, again, the wages becomes the biggest issue. And when you look at the private sector employees, when you look at averagely weekly hours at 35, would you rather have all of your employees go from 35 hours to 40 hours or hire another worker? And based on what they're seeing in the market right now, they would rather add hours to current employees versus hiring new people. So this is where you could start to say that the reopening comes in, because you still have a limitation on the amount of consumers that can be in your stores or people visiting your restaurant. So you don't need as many workers to cover the amount of people that will be in the store at any one given time. And these are some of the other capacity, which is why the problems that we're seeing are so complex and are linked very clearly to inflation and the cost of just, how do you pass through some of these costs in general? So then when we look at real personal consumption versus real household net worth. So net worth has gone up, obviously parabolic, but the personal consumption has also gone up and is back to pre-pandemic levels. But what is going to be the sustainability of that, especially when you start looking at that inflation side? Because personal consumption is going to abate, especially when you think about the wages and just how quickly you can see this continue to push through the system. Which is why when we look at the non-farm payrolls, this is where, as we said, we were going to get a strong bounce off the bottom and then really just go sideways. And again, the rate of change was going to be positive, but it was going to be a very slow rate of change as this cools off and the market tries to reassert itself and get comfortable with it. All the while, long-term unemployment, highest since the great financial crisis. 43% of unemployed individuals have been unemployed for 6 months or more. So now you have people where if you're a company, you have someone who's been unemployed for a month or someone who's been unemployed for 6 months. Who are you going to opt for? So that means that these individuals are going to have to accept lower wages to compete against people that are fresher from the job, that don't need to get back up to speed. This is where, in energy terms, warm stacked versus cold stacked. Somebody who has been sitting on the sidelines for a month is warm stacked. They're fresh. They still know what's going on. The longer you are, the rustier you're going to be, the longer it's going to take you to get back up to speed. Again, creating some of these long-term shortfalls. Then when we look at unemployment rates, the underemployment rate still remains at 10.4%, adjusted for the job and labor force, 8.2%, and then the unemployment rate starting to tick back up. But like we were saying, there's more people looking for jobs, so that kind of naturally ticks things back up. So the U.S. unemployment recovery path, you kind of get an idea of where things were. And this is just the path that is being highlighted here. I think that it's going to be the next, let's just say through July, it's going to be very important to see what these jobs do, to see if I'm right and we see this longer term trend, or if we can really see an acceleration, because this is showing you a much stronger rate of change than what we are assuming. And this is going to be kind of that pivot point of where are we going to see? But even if we get more activity, what price is it at? Like, at what wage level are you coming back into the market? And if it's at a very low level, well, then what is that going to mean for your consumption and your ability to move capital? So then when we look at the non-farm productivity quarter over quarter, the survey was for 4.3%, actual 5.4%. People are being more productive. And that means that you don't have to hire back as many people. Again, this productivity is almost kind of that net negative when you think about people doing more. But when we look at ISM service price index going up and the core PCE, everything that we're showing you, it just means that inflation is not done going up, even though you don't have people working at the same level, which is why that consumption pattern is going to be limited. But then when you look at unit labor costs are going back up. And so even though you're hiring back less people, you're still hiring them back, you're still paying them more, but you have to pass through that cost, which is why when you look at unit labor cost growth leads core inflation, again, just another side of the inflation equation that is going to pull things back up because you're going to try to pass through what you can. Just to put the jobs data in perspective, you can see that the jobs data here in the Great Recession, the non-farm payrolls were down 8 million. Even after this level, we're still 8.2 million below the worst recession we've had in the last 20 years. Again, speaking to the problems that remain in the system. Then when we look at U.S. employees on non-farm payrolls, this is just giving you kind of that check mark view in general. But when we look at average hourly earnings of production and non-supervisory employees, this is where the average hourly earnings of production on the leisure and hospitality side, because you have to try to pay them more, but it's not happening everywhere, which is why we see these residual issues. And then when we look at the unemployed workers on temporary layoff, they've essentially flatlined. So people are still being temporarily laid off, even though we're supposed to be getting a little bit better. And you can see the levels are well above going back to 2006 through 2010. The temporary layoffs still remain elevated, which is, again, some of the bigger issues why we continue to see pressure in this market, not only on the wages side, but these are individuals that want to come back, that are temporarily laid off, that would come back in a heartbeat, but at what price? And again, these are the pressures that remain in the system, keeping this disconnect between what the market expects for employment and jobs and then what we're actually seeing, and how this isn't a quick fix. This isn't just, well, repeal the extra money coming from the federal government and everyone goes back to work. That's not how this is going to get structured. It may help, but it's not the catch-all. It's not the fix-all. And that's where we're going to continue to see this slowdown, which is going to weigh on the recovery and the spending, which again is keeping me concerned about where that energy trade really goes.